Good afternoon, and thank you for the warm welcome. It is my pleasure and honor to speak to you at the 2023 conference of the World Forum of Central Securities Depositories in Prague. I wish to thank Sophie Turner for organizing this year's exceptional event, which unites the global financial community while fostering collaboration and facilitating the exchange of invaluable knowledge and expertise. Although I am unfortunately not with you today in Prague, my last visit was in September 2022. At that time, I had the opportunity to meet with central bankers, finance ministers, and regulators from around the world to discuss the most significant issues in global financial markets and potential solutions. I am pleased to continue the international dialogues that I began when I was sworn in as a commissioner just over a year ago. The pivotal role of central securities depositories in our financial markets cannot be overemphasized. These infrastructures serve as the backbone of the securities industry, facilitating the smooth functioning of post-trade settlement processes. They are crucial in maintaining the integrity, efficiency, and transparency of our capital markets. By providing a centralized platform for the safekeeping of securities and recording ownership, CSDs ensure that transactions are executed securely, reducing risk and fostering public confidence. Moreover, CSDs enable seamless post-trade activities for securities, including the transfer of ownership, dividend payments, and corporate actions, simplifying the complex web of interactions within this ecosystem. In essence, CSDs are the guardians of trust, enhancing market stability and enabling the growth and development of our financial system. CSDs are, in many ways, the foundation of financing our modern economy. The key themes of this year's conference, facilitating cross-border investment flows, settlement efficiency, systemic risk in post-trade processes, the vision for the global post-trade ecosystem, and lessons learned and the challenges ahead concerning financial market infrastructure, distributed ledger technology pilots, are particularly timely, considering the pivotal moment we find ourselves in the history of global finance. I will highlight some of these themes through the upcoming work I have planned through my sponsorship of the CFTC's Global Markets Advisory Committee and share some context surrounding them. The challenging macroeconomic environment has been marked by unprecedented volatility, uncertainty, and a constant evolution of geopolitical dynamics. Over the past 2 years, we have witnessed a series of geopolitical events that have significantly shaped the global landscape, creating a complex and ever-changing financial environment. Trade tensions, shifting political landscapes, the COVID-19 pandemic, climate-related risks, and cybersecurity issues have all played a substantial role in shaping the financial markets and the key regulatory trends that stakeholders should be monitoring and addressing now and moving forward. Ongoing trade disputes and political unrest in various regions have introduced uncertainty and volatility into the global financial markets. The COVID-19 pandemic presented challenges with far-reaching consequences for the global economy and financial markets. In response to the economic turmoil, central banks worldwide, including the Federal Reserve System, implemented extraordinary measures to support the economy, such as lowering interest rates and implementing quantitative easing programs. Policymakers face the arduous task of maintaining stability while addressing mounting debt burdens, rising inflationary pressures, and the need for sustainable growth. Fluctuations in the prices of U.S. Treasuries, as well as equities, currencies, and commodities, have affected investors worldwide as the dynamics of global trade continue to evolve. At the same time, the derivatives and equities markets have witnessed an accelerated adoption of technology and digital platforms, accompanied by a surge in retail investor participation. The impact of climate change has emerged as a critical risk factor for businesses and investors alike. The frequency and intensity of natural disasters has increased, raising concerns about the long-term sustainability of certain industries. These developments have directly influenced the financial markets, with investors continuing to consider environmental, social, and governance factors when making investment decisions. This shift in mindset has led to an increased demand for ESG-focused derivatives, funds, and products. As we have seen in recent years, the threat landscape has evolved rapidly as well. Cyber criminals are becoming more sophisticated and aggressive, targeting financial institutions and infrastructures with a range of tactics, from ransomware to hacking into systems and stealing sensitive information. The increasing sophistication of cyber criminals and the growing reliance on digital technologies make it imperative for financial institutions and infrastructures to invest in robust security measures, employee training, and incident response plans. As the saying goes, an ounce of prevention is worth a pound of cure, and investing in cybersecurity measures can save institutions from potential financial losses and reputational damage. To address these multifaceted challenges, a proactive and coordinated approach is essential to mitigate risks while embracing opportunities. It is evident that no single country or regulator can tackle these challenges alone. In this age of globalization, our financial markets are more interconnected than ever before, making international coordination and cooperation essential. We must work together as a global financial community to address these challenges and safeguard the integrity and stability of our markets. Throughout my travels during my first year in office, I have been fortunate to visit over a dozen countries, and I've spoken with central bankers, finance ministers, policymakers, and leaders in each country. And what I have learned from all my meetings is that the issues in our financial markets are borderless, and their potential impact is not confined to any single jurisdiction. Accordingly, I'm actively engaging with the CFTC's counterparts to share knowledge and best practices to enhance our collective resilience against our shared challenges. Regulators, market participants, and other policymakers must work together to foster transparency, promote stability, and encourage innovation in the global financial markets. I encourage each one of you to actively engage in the discussions, share your insights, and forge new partnerships. By fostering a spirit of collaboration and open dialogue, we can collectively evolve our financial market infrastructures and build a more resilient and sustainable global financial system. Since assuming my role in April 2022 as one of the 5 independent commissioners of the CFTC, I have had the privilege of sponsoring the CFTC's Global Markets Advisory Committee, or the GMAC for short. Throughout this period, I have focused on strategizing, planning, and working diligently to relaunch this invaluable committee. My approach has been centered on gathering comprehensive information about the key issues facing our global financial markets through international policy dialogues and conversations with market participants, and using this information to formulate pragmatic solutions that can be actioned now. I am inspired by the tremendous potential that new technologies present to solving old problems. We may be on the precipice of a new era, one that will redefine the way we approach market oversight and regulation. It is a time of profound change, and we must embrace it with open minds and a forward-looking perspective. Last week, I announced the launch of my proposed work program for the GMAC by outlining a series of initiatives aimed at fostering innovation and enhancing global financial market resilience. As we move forward, it is crucial to recognize the interconnectedness of our global financial markets and the need for collaboration across borders. The GMAC will serve as a forum for global market participants, regulators, and other stakeholders to come together and address the challenges and opportunities presented by a rapidly evolving financial landscape. The GMAC's proposed work program follows our expert presentations by GMAC members on the most significant issues in global markets at the GMAC's inaugural February 13th meeting earlier this year. This work program proposal is a key milestone for the GMAC and the result of our global stock-taking exercise over the past year, including public comments and international policy dialogues. The GMAC and its 3 subcommittees, Global Market Structure, Technical Issues, and Digital Asset Markets, will work over the next 2 years to recommend pragmatic and actionable solutions to the CFTC regarding key issues and policy proposals for global markets, including global market structure and access to markets. For digital asset markets, including digital finance and tokenization of assets, non-financial activities in Web3, and blockchain technology. And for technical requirements that apply to global markets, including financial market infrastructures, market participants, end users, and service providers. Through the work of its members, the GMAC aims to identify and address the challenges and opportunities that lie ahead for the global financial markets. First, I'll start with the GMAC's Global Market Structure Subcommittee. The first set of initiatives will focus on these 5 key areas: Treasury market reform impact on derivatives markets, the role of derivatives for proper asset liability management and functioning of funding markets, global standards and best practices for market volatility controls and circuit breakers, improvements of liquidity across asset classes, including commodities, rates, and credit markets, with respect to capital, clearing, and collateral requirements, and recommendations to achieve international alignment of trading and clearing obligations to address market fragmentation, including swap execution facility and multilateral trading facility requirements. First, regarding Treasury market reform impact on derivatives markets. The facilitation of cross-border investment flows has arguably had a significant impact on the U.S. Treasury market. Over the last several years, we have seen cross-border investment flows into the U.S. Treasury markets increase, resulting in higher prices and lower yields on U.S. Treasuries. In March 2020, the U.S. Treasury market experienced unprecedented volatility and illiquidity as investors rushed to safe haven assets like U.S. Treasuries due to the outbreak of the COVID-19 pandemic. This sudden surge in demand, which was driven by factors such as market participants' increased demand for cash, large-scale sell-offs of Treasury securities, and heightened uncertainty, led to significant price dislocations and a breakdown of the market's normal functioning. While the Federal Reserve ultimately intervened with emergency measures, including large-scale asset purchases, to stabilize the Treasury markets, one of the key issues identified during the market panic of March 2020 was the margin requirements on leveraged transactions in the U.S. Treasury market. In response to such issues, proposals for reforming the U.S. Treasury market have been put forward by various regulators, including the Federal Reserve Bank, the Treasury Department, and the Securities and Exchange Commission. The proposed reforms aim to address market structure, technology, and regulatory issues to ensure that the U.S. Treasury market remains stable, liquid, and efficient in the face of evolving market conditions and future potential challenges. Recent market events and conditions, inflation, rising interest rates, credit tightening, and stresses in funding markets underscore the importance of examining cross-margining between derivatives and cash markets. Cross-margining between derivatives and cash markets directly impacts the stability of our global financial markets, including the U.S. Treasury market. For these reasons, the GMAC Global Market Structure Subcommittee will examine the impact of Treasury market reforms on the derivatives markets, particularly in terms of cross-margining between futures and cash markets. By examining these practices, my hope is that the GMAC work program will provide expert recommendations to the CFTC to reduce systemic risk, improve capital efficiency, and promote market stability. Furthermore, this GMAC subcommittee will assess the potential changes to derivatives market structure resulting from cash market reform proposals and ensure that these changes do not undermine the integrity and efficiency of our global derivatives markets. Next, the role of derivatives for proper asset liability management and functioning of funding markets. As we continue to watch stresses in the U.S. regional bank sector from struggles and pressures from rising interest rates and the flattening yield curve, leading to reduced net interest margins and slower loan growth, it is productive to examine the role of derivatives for proper asset liability management and functioning of funding markets. The GMAC Global Market Structure Subcommittee will examine the extent to which there are structural issues in regulation that create incentives or disincentives to using derivatives for effective asset liability management and the smooth functioning of funding markets, including risk management, hedging, price discovery, liquidity enhancement, and portfolio diversification opportunities. Next, global standards and best practices for market volatility controls and circuit breakers. In the aftermath of the LME nickel crisis last year, as well as issues in the energy markets, settlement efficiency through the adoption of global standards and best practices for market volatility controls and circuit breakers is needed in our increasingly interconnected global financial system. I believe it is essential to have a consistent and harmonized approach to managing market volatility by allowing for timely intervention, improved transparency, and a consistent application of rules. Divergent practices across jurisdictions can create regulatory arbitrage opportunities and exacerbate cross-border risks, undermining the overall stability of the global financial system. Starting with timely intervention, global standards and best practices may have provided a framework for monitoring nickel market conditions, identifying signs of excessive volatility, and triggering appropriate measures to halt trading or impose price limits in a timely manner. Improved transparency requires effective supervision. Clear guidelines and communication protocols will ensure that market participants are aware of the measures that will be employed by exchanges and clearinghouses to manage volatility, thereby reducing the likelihood of panic and confusion in the market. In addition to transparency, consistent application of the rules is necessary. Global standards and best practices ensure that all market participants are subject to the same rules and restrictions, reducing the possibility of regulatory arbitrage and creating a level playing field for all market participants. With this in mind, the GMAC Global Market Structure Subcommittee will explore and provide recommendations to the CFTC on global standards and best practices for market volatility controls and circuit breakers. Improving liquidity across asset classes. Recent global market events, such as the 2008 financial crisis, flash crashes, debt crises, and crashes in the prices of global commodities, demonstrate that liquidity issues in global financial markets can have significant consequences for financial stability, economic growth, and investor confidence. I believe it is critical for regulators and market participants to continuously monitor and address liquidity risks to ensure the smooth functioning of our global financial markets. And I view recommendations to improve liquidity across asset classes, including commodities, rates, and credit markets, with respect to capital clearing and collateral requirements as one of the key starting points on which to build on the GMAC's proposed work. Finally, international alignment of trading and clearing obligations to address market fragmentation. The GMAC subcommittee's focus on international alignment of trading and clearing obligations will aim to address market fragmentation by looking at the possibility and likelihood for harmonizing regulations and requirements across jurisdictions, including CEF and MTF requirements. For CEFs and MTFs, the potential for market fragmentation exists when regulatory differences create inefficiencies and barriers to entry for market participants, potentially leading to reduced liquidity and increased costs. It is important to address these potential causes of market fragmentation. The second set of initiatives of the GMAC work program will be handled through the GMAC's Technical Issues Subcommittee. This subcommittee will focus on 4 key areas: providing recommendations on improving international standardization and amalgamation of trade reporting for swaps market oversight, providing recommendations for global coordination of market events such as closures, drills, or recovery from disruption. Third, providing recommendations to improve efficiencies in post-trade processes. And fourth, identifying other infrastructure issues to address that impact cross-border activity and access to markets. First, improving international standardization and amalgamation of trade reporting for swaps. Given my previous work in the private sector, where I implemented global financial regulatory reforms for a GSIB, I am particularly interested in finally achieving a key pillar of the G20 derivatives reforms: transparency, as well as the discussions surrounding non-bank financial intermediaries' use of leverage in the over-the-counter swaps markets. A lack of prudential regulation over NBFIs has the potential to magnify and transmit stress across the broader financial system. For these reasons, the Financial Stability Board has been working to improve data collection and analysis for NBFIs. Through such data collection efforts, regulators will be able to better understand the potential risks NBFIs pose to the global financial system. I am pleased to share that my proposed GMAC work program will provide recommendations on improving international standardization and amalgamation of trade reporting for swaps market oversight and to enhance the ability of supervisors to identify systemic risk. Next, global coordination of market events such as closures, drills, or recovery from disruption. There is a public interest component in ensuring that, in the event of a market disruption, any resulting dislocations in the financial markets are curbed so that market participants remain confident in their ability to access their funds and that markets are working smoothly and well. For example, when UK-based Ion Clear Derivatives was hit with a ransomware attack this past February, many US-based financial firms who conduct business with the software provider were prevented from reporting their daily trade data to the CFTC for several days, as well as the US subsidiaries of non-US financial firms. As a result, the CFTC was forced to delay the release of its weekly Commitment of Traders report. While the Ion incident was concerning, fortunately, it proved to be short-lived and serves as a good reminder that global coordination during any type of market disruption is necessary. Immediately following the attack, the CFTC worked around the clock with its domestic and foreign counterparts to assess the impact to our global financial markets. The CFTC then issued a statement to the market concerning the incident and its expectation of associated reporting delays. For the industry, it was important to work together to find a way to recover from this disruption in a coordinated fashion. And so, for these reasons, the GMAC Technical Issues Subcommittee will explore best practices for global coordination of significant market events involving recovery from disruption, market closures, and market drills. Finally, improving efficiencies and post-trade processes. It is no surprise that advances in technology continue to transform the global financial markets. However, much of these improvements are focused on front office processes or revenue generating activity, often through the implementation of AI or machine learning protocols. As a result, post-trade process activities, including reporting and collateral management, continue to rely on outdated programs or human intervention that vary between market participants and jurisdictions. I believe we need to do a better job at addressing the risks to operational resilience posed by inefficient post-trade processes. A fulsome discussion on how firms can employ new post-trade technologies to modernize and improve operational resilience is very timely. It is my hope that members of the Technical Issues Subcommittee will also consider whether there are any targeted or immediate adjustments that could be made to globally align and improve post-trade processes. Other infrastructure issues that impact cross-border activity and access to markets include inconsistent regulatory frameworks and divergent regulations and standards across jurisdictions that can create challenges for institutions operating in multiple countries, leading to inefficiencies and higher compliance costs. Fragmented market regulation leads to disparate systems and processes that can hinder the seamless flow of cross-border transactions, resulting in increased operational risks and reduced efficiency. In addition, cross-border transactions are vulnerable to cyber threats, necessitating robust cybersecurity measures and strong cooperation among market participants and regulators. With respect to market liquidity and volatility, cross-border transactions can be exposed to volatility in financial markets, which can increase the costs of transactions. To address these issues, international organizations like IOSCO and CPMI have developed the principles for financial market infrastructures to provide a common set of standards and guidance for improving the resilience and efficiency of financial market infrastructures. Policymakers and regulators must work together to promote greater harmonization and cooperation in the oversight of cross-border financial activities to mitigate risks and ensure stability. The third set of initiatives of the GMAC work program will be handled through the GMAC's Digital Asset Markets Subcommittee. This subcommittee will focus on the following three key areas. First, recommendations for industry standards and best practices for tokenized asset markets, including digital asset taxonomy, pre-trade execution and post-trade requirements, and governance risk and control frameworks. Second, recommendations for the regulation of non-fungible tokens and utility tokens. And third, identifying other issues to address in digital finance and tokenization of assets, non-financial activities in Web3, and blockchain technology. FinTech continues to present new opportunities and challenges within the global financial system. Digital finance and tokenization of assets, non-financial activities, and Web3 and blockchain technology are transforming the way we conduct business and interact with financial systems. These innovations have the potential to increase efficiency, reduce costs, and enhance financial inclusion. However, they also pose new risks and challenges that need to be addressed through effective regulatory frameworks and cooperation among stakeholders to ensure the overall stability and integrity of the financial system. I believe that identifying the issues associated with digital finance and tokenization of assets, non-financial activities, and Web3 and related blockchain technology should be shared with our global counterparts and stakeholders. While the international community has already taken steps to address such issues, much work remains. Through the GMAC's Digital Asset Market Subcommittee, we will explore how digital assets taxonomy is essential for understanding and categorizing various types of digital assets, such as cryptocurrencies, NFTs, and utility tokens. I believe such classifications will help regulators and market participants to establish a common language, ensuring that regulatory compliance is maintained and fostering innovation in the digital asset space. With regard to pre-trade, execution, and post-trade requirements, this refers to the processes and regulations surrounding the trading of digital assets. It is imperative that these requirements ensure fair and transparent markets, protect market participants, and reduce risks associated with fraud and manipulation. Effective regulatory frameworks for digital asset trading contributes to the resilience and integrity of the financial system. Governance, risk, and control frameworks are critical for managing the various risks present in digital asset markets, such as cybersecurity threats, market abuse, and operational risks. Effective governance and risk management practices help maintain market confidence and protect the interests of investors, market participants, and other stakeholders. The regulation of NFTs and utility tokens is important because these assets have gained significant attention and value in recent years. Ensuring that there are clear rules and regulations in place helps protect consumers, prevent fraud, and maintain the stability of the financial ecosystem. The next GMAC meeting is scheduled for July 17th and will take place at the New York Stock Exchange. At that meeting, the GMAC will explore Treasury market reforms, swap block trade thresholds, market volatility controls, and tokenized asset markets. Global issues call for global solutions. The strength of our global financial markets and the stability of our global economy depends on our ability to work together in the face of these challenges. I am pleased that through the GMAC, we will provide a forum for experts to drive solutions and inform international standards. I am confident that with the continued dedication and cooperation of regulators, market participants, and stakeholders worldwide, we will be able to create a more secure and resilient global financial system. Thank you.